Hey everyone, Chris and Jason here with the Private Lenders Podcast, sponsored by our mastermind group for hard money lenders. Check it out at hardmoneymastermind.com. You can create a free account, join the conversation with us and other private and hard money lenders from around the country. Okay, so today we are talking about second mortgages. Should private lenders do second mortgages? What are the risks? What are the rewards? And what are the things that you should be aware of coming from people who have experience with this sort of thing?
Yeah, I think this topic came up multiple times in the mastermind group, and I caught myself chatting, texting, or typing, and I'm like, "This is too hard to type. Let's just do a video and a podcast." I think there's a lot of benefit because it comes up all the time. Potentially people are attracted to doing second mortgage because you can get a higher interest rate of return. So that's usually the number one thing. Number two is you don't have to outlay as much money. Right? You come in as a second mortgage, you come in as a gap funder, let's say. So let's say they find someone to do a loan for $150,000. They just need $25,000 as the gap, hypothetically. It's like, great, you'll pay me a higher interest rate of return. There's a lot less money out, but there's a lot of risks in doing a second mortgage. And not that a second mortgage is unsecured, because it's not. You still have a lien against the property and a security instrument against the property, but it could be unsecured, right? It could be worthless if something really goes bad with the first lender, because the first lender has all the priority, right? So if they don't pay their first lender, and you can say, well, they want to come in after the fact and they're already performing with the first lender. Well, they might be performing today, but if they're not, but they might not be performing tomorrow. So in essence, if the first lender is not getting performance, there's not performance from the first lender, or they're not paying their first lender, they go to default. In essence, you're going to get wiped out completely, unless obviously there's enough equity cushion that it goes to auction, and there's enough to pay you off. But we're going to talk about some tips of how to structure these here in a second. But I think it's important to understand that you're second in line across the board. You're not first in line, and they could run into issues.
Yeah, so we're gonna definitely break down what deals look like that we will consider funding as a second. The ones you can stay away from. It's interesting too, because we see it from both sides. Like typically, 99% of the time, whatever it is, we're doing first liens, and so are most private lenders. And there's often money behind us. It could be closing at the time of closing when we fund our loan. It could come later, but there are different scenarios that we're going to talk about here in the podcast today that we've seen a lot. And we've seen some people do it the wrong way many times. I would say most of the time somebody's doing a second mortgage, they shouldn't be doing it. Wouldn't you agree?
Exactly. And that'll probably, if we jump into some tips, that'll leave us to the number 2 tip. Let's start with the number 1 tip real quick. And I'll add to that. So the number 1 tip obviously is you got to do a lower LTV, than normal, right? If you're a first lender and you want to be in it at a 65% LTV, like you can't be a second lender and go up to a 65% CLTV, combined loan to value, right? That doesn't fully make sense, because as they potentially default on the first, that first lender's principal balance is going to increase. And it's going to squeeze you. And it's very common, especially if you're potentially behind a hard money lender, for you to get squeezed out completely, right? Because the borrower doesn't make payments for a period of time. They don't pay their taxes, just like any other default, right? The balance goes up. I would probably say the top recommendation is do not be behind a hard money lender, because there could be a lot of unknown costs that potentially being behind a bank has. And we can discuss that, because I think that's one of the best tips is you have to get the first mortgage note. You need to understand who's in front of you. That first mortgage note tells you everything. I'll give you an example. Let's say the borrower has a bank note for $100,000 and the property is worth $400,000. There's a big gap, right? And let's say it's a bank, and based on that note, that if the borrower does not make a monthly payment and they default, that they get stuck with some late fees, some miscellaneous charges, something that's reasonable, that won't just jack up the principal amount and the full payoff, right? Maybe they'll have some attorney fees if they have to foreclose. So in essence, let's just say the borrower doesn't make a payment. The payoff goes from $100,000 to like $120,000 in a year. That's okay. And let's say you come in to do a small second behind that. Your risk is probably pretty low in that case. We're going to talk about some things related to making sure you have the ability to pay off the first if you need to. We'll get to that. But your risk is a little bit low. Let's look at this another way. Let's say you're behind a private lender, a hard money lender, or some other type of lender that has in their note a high interest rate default rate. Potentially their attorney fees could be higher. They have higher late fees, whatever it is, right? All of a sudden that $100,000 could turn into $200,000. And again, there's still, in this particular case, there's still enough equity, but you really got to know what's going on in first. Keep in mind, there's lenders that potentially have joint venture agreements with borrowers on creative deals that it says, hey, I'm going to give you $100,000 to buy this property, but you're going to give me $200,000 on the back end as a joint venture equity agreement. Now, I understand that some states that might not be legal in. I mean, most of the stuff that we all play in is creative investor transactions, but like that could happen. Like, hey, I'm gonna be a partner with you. I'm gonna put up 100, and you're gonna give me, whatever, a big sum of that at the end. Well, you need to be aware of that if you're gonna give this person, money as a second mortgage, because that impacts you.
Yeah, for sure. No, I was thinking of a couple scenarios just as we were talking about doing the podcast, and since we started to, so like I have some interesting perspective on this, mainly seeing people do it wrong because I manage our defaults at HMB, or manage our defaulted loans in the portfolio. And there's a situation. Here's the exact situation that you don't want to get in. Let's start with that too. Okay. So like Jason alluded to and started to get into, is that if you're doing a second mortgage, you need to have funds to pay off the first in the event of a serious default or getting near foreclosure, right? Number one, and it's the number one mistake made, is that a lot of people who are doing seconds that we see are often less savvy investors who want to put some money out, earn an interest rate return. Some real estate investor says that you can make X if you give me 50 grand or whatever it might be. And they get into that exact situation where if they get into default with us, or maybe the property's not totally complete, that's the cash they had available. They don't have enough to buy out our loan, or maybe even put out additional money to get the project done, to get that, loan to value and the value of the property where it needs to be. So there was a scenario that actually cleared up this year as an ongoing default situation in Pennsylvania, where we had given a borrower 2 loans, one on each property he was doing. I think they're on the same, might have been connected houses or same street, something like that. And we didn't know this, but later on he took out a second loan from a private investor against both properties for construction funds. So, okay, that right there is not necessarily a horrible thing to do on either, for either party, but he ran out of funds to finish the construction. And the lender who did the loans behind us is a pretty savvy business guy, but he was not savvy in this, right? He's a finance guy. He put some family money into it, and he was in a position where we were going to foreclose and he was going to get wiped out. And so we made a deal where he was going to put up the rest of the money to complete the properties just to recoup as much principal as he could. He wasn't getting all of his principal. He wasn't getting any interest. He was just trying to get his relatives' money back. And that's not a good spot to be in, right? And we made a deal with the guy, and they did finish the properties and they sold in a good market, and he recouped a lot of principal. I don't know the exact numbers on that or percentages, but it wasn't a good spot to be in. It was not a deal that he should have done. And that's exactly the kind of deal that is most common with second mortgages, and what you should know to stay away from.
Yeah, I think anything that's you're going to be a gap funder is trouble. I think that ends up being trouble if you're going to be a gap funder. And what I mean by that is, hey, the total cost of the project's 125. I can get 100 from a hard money lender, and I need 25,000 to bridge that gap. The numbers are just too tight. It just doesn't make sense. They're in it for the wrong, it just doesn't work in that case. You're going to get squeezed. You're going to get squeezed out. On the other side is, let's say we talk about the example earlier. A borrower owns a commercial building or a rental property with $100,000 balance. They don't want to refinance with you because they have good debt on it. They have a 4% maybe long-term debt on it, but they need $25,000 to do something, bridge something. And it's worth 400 grand, do it. I mean, it's not, I shouldn't say do it, like consider it, right? But you got to look at the first mortgage to see how that's set up. You got to figure out what's your game plan going to be. Two things. What's your game plan going to be if, these guys stop paying and it goes into default? Do you have $100,000 to potentially pay off the first? How are they going to repay you? Is there a clear exit strategy in play? If someone has a rental property that they don't want to pay off their first mortgage because it's a good interest rate, and you give them a loan of $25,000 to, I don't know, maybe do some improvements, maybe invest in another business, like there's no exit strategy tied to that transaction. So you got to think about that as well. So again, I don't know if we've actually ever done just a solo second. I'm not saying we wouldn't in the right scenario, and we probably have.
I'm sure we have. Yeah.
We probably have over the years. I mean, I know potentially we've done seconds kind of behind our own firsts where we can control because it was easier than doing a full refinance for somebody. That's possible, but it's just something to think about. I don't think the rule of thumb is like what CLT, what combined loan to value is. It's certainly, probably no higher than 50. I would say somewhere like that, but
right.
there's other things that kind of go into the mix. But if you're a private lender or hard money lender and you've gone through the full cycle of a defaulted loan, like you've had a full defaulted loan that's sold at auction or you took back, like look at those numbers, how they played out. Look what your original loan amount and LTV was, and then look at where it was at the end of the day. It for the most part will eat up all the equity. So you can't do it behind a 65 LTV first. It doesn't make sense. And I know why people are attracted to it. We started with this higher interest rate, lower amount of capital requirement to get into a deal. I get it. Like it makes sense. But there's just too much risk unless you can, you have some sort of way to get yourself out of it.
Yeah. So another note on that, I know that people have asked before in the mastermind and just in conversation with lenders, like, how do you know that you can pay off that first? So you do have the means to do it. You have the capital to pay off that $100,000 first. How do you know that you'll be able to do so? So a few comments on that. I don't know like what kind of law that would fall under or, whatever you would call that. But if you're a mortgage lender of any kind on a property, like a private lender, bank, whatever it may be, and somebody asks you for a payoff statement, you have to give it to them. You can't just be like, nope, can't give you a payoff. I'm going to keep rolling default interest, or maybe I'm going to take this to auction sale and try and own it. I don't know exactly how that's illegal, but it's not legal, right? I'm not a lawyer. I can't say exactly how, but you can't refuse somebody a payoff statement. Now, it might be a big payoff, like maybe there's missed payments and late fees and whatever the terms of that note are, but they can't deny you a payoff statement. Now, it might require like an attorney letter. Who knows? Maybe like it's somebody who's hard to locate, a private lender who's not super public. But still, at the end of the day, you're going to be able to pay off that loan if you have the means to do so. You might have to call a lawyer, might have to write a letter, but to answer that question, because I know people have asked that before.
Oh, like okay, got it. Yeah, exactly. Like, if you got to go through a law firm to send a wire to that first mortgage lender. But yeah, I mean, hopefully this is helpful. I mean, these are things that, creative ways to structure deals we look at all the time. Ideally, if you can, I'll tell you, like we have a lot of second mortgages out, but a lot of them are behind cross collateral that we just use for additional collateral, right? So we do a first mortgage for somebody and, we're going a little bit higher than we want. So they have a bunch of other properties that, we potentially put a second mortgage against. It gives us a little bit more breathing room. Again, the intention might not be to collect on those. It might be hard to collect on those without paying off the first, but we know that the first project, the first lien we have, even if it's not, perfectly written, it might be a little bit more aggressive than we would like. We know that we still should be able to collect all of our money from that. And we don't have to go collect on some of the second mortgages, but if we can, collateralize some additional stuff to have safer loans, we're going to do it.
Absolutely. The way I would, for everyone out there listening, watching, the way I would look at second mortgages is one, don't base your business on that niche of lending, right? It's not like a full portfolio of like, I do all these seconds and stuff. It's not going to play out that way. There aren't enough of them that make sense. However, be smart about it. Keep your eyes open. Like, it could create an opportunity to make some money to put out a good loan, where a lot of your competition, they won't know how to do it. They might just have a blanket rule of, oh, we don't do seconds. It's like, oh, well, what if it's a 10 LTV? Do you still not do seconds? Right.
Yeah.
So
yeah, go ahead.
I would look at it as just an occasional opportunity to be aware of, to know how to structure it in the right way if it does pop up. And I bet it will on occasion, once a year, once every couple, whatever it might be, right?
Yeah, and you can charge a premium for it. You know, I mean, I get the, I certainly get the attraction for it, to it. I just, you know, and you, like Chris said, if you want to do it kind of on a small scale on a deal that makes sense, but just make sure you have the ability to get that first mortgage lender paid off. Somehow you're going to put yourself in a scary spot. And keep in mind, you can still foreclose on a second mortgage, right? You know, if you're low enough LTV, you can go force a foreclosure, and potentially, you know, if it sells for higher, then, you know, you can potentially collect fully, right? If it ends up selling at auction for the full first and the full second amount. But there's too much. And again, it's not unsecured. It is still a lien, but you just got to be careful.
Absolutely. No, but good questions from everyone in the mastermind. We're happy to address more things like this, specifically on video and audio, that, like Jason said at the beginning, could work out better than just us chatting, which we do all the time. We're, you know, constantly chatting with people in the mastermind group, but sometimes there's something like this that makes sense for us to jump on video and really break down for you. So anything else like that, we're happy to jump on video and do that. So let us know, hardmoneymastermind.com. If you're not a member already, go create a free account, join the conversation with us, and we will see you in there.